कॉम्प्लिकेशन कौन सा देखिए no no एक आप फूट ही नहीं
Hello, friends. Welcome to the first episode of the GSTPod series for financial year 24-25. This is a new offering which we are just starting with from this period. And the idea is to really harness the technology and provide quality services to our clients and to our viewers. Uh, as we start the new financial year, we are all aware that as far as GST is concerned, there are substantial year-end compliances which might be required. And we thought that this could be a good start to look at a 10-minute snapshot of what are the key year-end compliances required from the perspective of GST. We plan to keep this as a weekly exercise, and every week we will have a very short 10 to 15 minutes podcast covering one or the other concept of GST and also providing you updates of the happenings in GST during that entire week. So enjoy your podcast and let's straight away begin into the aspect of GST and the year-end compliances. We are aware that due to the change in the financial year, there are certain obligations which are cast under the GST law and even under the accounting principles. And all of them have some action points under the GST law. So this podcast will deal with three broad obligations which are from a GST perspective due to the change in the financial year from 23-24 to 24-25. The first set of changes which we will be talking about relate to certain obligations or concessions granted to small and medium and micro enterprises under the GST law. And a lot of those obligations and concessions are connected with the aggregate turnover. We'll go into the concept of aggregate turnover, and based on the previous year's aggregate turnover, there are various obligations relating to registration or deregistration, applicability of composition scheme or ineligibility therefore, the filing of returns and the due dates for that, and certain exemptions, especially as far as RCM is concerned. So we'll deal with that as one basket of changes which we'll be talking about when we look at the change in the financial year. There are other GST obligations in terms of procedures to be followed at the year end, certain options to be exercised in terms of payment of taxes, either a concessional rate or a reverse charge or a forward charge mechanism, and also certain timelines to be followed. And all of that we'll be talking about the second basket of issues which govern this aspect of change of the financial year. Finally, a change of a financial year necessarily implies a lot of accounting entries and provisions and other aspects being created in the books of accounts. Because GST is a transaction driven law and the transactions are primarily reflected in the accounting systems, and there is a requirement of a reconciliation, the year end accounting treatment presents certain implications from a GST perspective. So we'll be dealing with that in the third basket of discussion which we are going to have as of today. So these are the three things which we'll be talking about. And without much ado, let's straight away go to the concept of aggregate turnover. We are aware that section 2(6) defines the concept of aggregate turnover, and the definition is a catch-all type of a definition. It's very wide. It means the aggregate value of all taxable supplies, excluding of course where you are paying tax under reverse charge mechanism under for an expense. So all your incomes typically get covered within the purview of aggregate turnover. Exempt supplies also, it's not only just the taxable supply, exempt supplies, exports, interstate supplies. Of importance is the fact that all the registrations having the same PAN, you have to aggregate all the turnover. We are all aware of this factor that you might have certain states where your turnover is low, but certain states the turnover might be high. The aggregate turnover concept takes into account the PAN India or the PAN entity level turnover, and therefore it has to be taken into account across the entire basket. It of course excludes the taxes, which is the central tax, state tax, UT tax, and the integrated tax and cesses. So this is the definition of aggregate turnover. And as you can see, this aggregate turnover definition, it includes even exempted supplies. And a major challenge which many a times we face is the interpretation of interest income. And friends, make no mistake, interest income is an exempted supply. Of course, it does not require a reversal because there are certain places there are concessions specifically granted to say that this value will not be included. But when you're calculating the general catch-all word aggregate turnover, you will have to take into account all types of some values for taxable supplies and exempted supplies also, which forms a consideration for an exempt supply of lending to a third person. Now, based on the value of the aggregate turnover, there are various obligations, and I think the primary obligation is the requirement for registration. And we are all aware that depending on the aggregate turnover in a financial year, the mandatory requirement to obtain a registration kicks in. So therefore, if your aggregate turnover exceeds 20 lakhs, or in certain smaller states 10 lakhs, and in case of supply of goods 40 lakhs, these are the three cutoff limits. And if an entity has an aggregate turnover beyond these limits, he is mandatorily obliged to obtain a registration. Most of the live examples, a person would obtain a registration much before that. There's also a concept called voluntary registration. So a person might want to obtain a registration because it, in a way, gives you a GSTN, which permits you or enables you to undertake trades frequently and seamlessly with your customers and suppliers. And therefore, this aspect of aggregate turnover becomes limited in terms of interpretation only to the cases of fresh persons who are below the threshold limit and do not want to obtain registration. Please note that there's no exemption limit of 20 lakhs under the GST law. This is just an aggregate turnover threshold for registration. Once you are registered, even if your turnover falls below 20 lakhs, you are still required to pay the tax on the actual turnover, whatever you might be having. Of course, at some point of time, if your aggregate turnover consistently is below 20 lakhs, you can apply for cancellation under section 29, and post cancellation, naturally, you will not be required to pay the GST. So first aspect which comes is this section 22, where you will have to check, especially if you are unregistered, whether you are liable for registration, and if so, then go ahead and obtain a registration. Section 10 deals with composition. Again, when you are looking at composition, the eligibility for a concessional composition rate without an input tax credit is dependent on the aggregate turnover in the preceding financial year. So therefore, depending on the turnover in financial year 23-24, you may choose to opt for composition, or you may choose not to opt for composition. If you are opting for composition, it's important for you to file a document called CMP2 and also file an annual return in ITC 03. So that is the compliance. And again, for that purpose, the concept of aggregate turnover becomes relevant, which changes at the end of each year. Similarly, if you are a small trader having a turnover of less than 5 crores in the preceding financial year, you are eligible to file quarterly returns under the QRMP scheme. QRMP stands for quarterly returns, monthly payment. Make no mistake, every month you have to estimate the tax liability and pay the tax. You may file a GSTR1 on a quarterly basis and 3B on a quarterly basis, but the payment of taxes has to be on a monthly basis. Now, when you are paying taxes on a monthly basis and the customers also want a credit, naturally, you will be filing GSTR1 on a quarterly basis, and the customers may not be interested in giving you the reimbursement of the tax because the credit is not reflecting in their accounts. Therefore, you can file what is known as an invoice furnishing for facility. So there's an IFF. You can furnish the invoice through that on a monthly basis. So effectively, when you look at QRMP, while it does permit a quarterly return and a monthly payment, it does not really simplify the situation to a large extent. And therefore, in many cases, we suggest do not opt for a QRMP scheme, go for a normal mechanism only. But in specific situations, especially where you are a small trader and have lots of B2C transactions and very limited B2B transactions, you may choose to go for a QRMP scheme if eligible. And if you are eligible, then the opt-in and opt-out happens at the end of each financial year. And therefore, Rule 61A you can follow and choose to be either in the QRMP scheme or under the normal scheme. Notification 78, we are aware, requires you to mention HSN on your invoices and all your documents. And for that purpose, the number of digits of the HSN to be mentioned changes based on the turnover. If your turnover is less than 5 crores, then you may mention 6 digits. Otherwise, if is less than 5 crores, then you will mention 4 digits. Otherwise, you can mention 6 digits is required if it is more than 5 crores. So that is as far as the HSN is concerned. Aggregate turnover also has an impact on the due dates of filing the GSTR 3B, because for people less than turnover of 5 crores, there is an extended due date of 22nd or 24th, depending on the state in which they are registered. And accordingly, they can choose to have that buffer of 2 or 4 days instead of filing the GSTR 3B on the 20th itself. Again, when you are filing GSTR 9C, there's a concession. If your turnover is less than 5 crores, you may not file GSTR 9C, and it's required only if your turnover is above 5 crores. Notification 13 is an important notification, which, as we are all aware, over a period of time, e-invoicing has been extended drastically. And as of now, any entity having an aggregate turnover exceeding 5 crores in any of the preceding financial years, the IRN is mandatory. And nowadays, there have been lots of notices being issued. If a requirement is there of an IRN and an IRN is not generated, then notices are being issued by the states. And therefore, it's important to recheck this aspect, that whether there is an obligation to generate an e-invoice, and if it is there, make sure that the systems are compliant to generate the e-invoices in the correct manner. Please note, as compared to any other provision, as far as the IRN provisions is concerned, the e-invoicing triggers if the aggregate turnover exceeds 5 crores in any of the preceding financial years. It's not just the immediate preceding financial year, but right from 17-18 till today, if in any of the earlier financial years your aggregate turnover was above 5 crores, then IRN is required. Now, a couple of exemptions. There is an RCM applicable for services rendered by the government and services rendered by advocates and legal tribunals. And in that situation, there is an exemption notification which says that if you are a business entity and your aggregate turnover is such that it is below the threshold required for registration, which is the 20 lakhs, which we talked about earlier, in that case, the RCM is not payable, and there is an exemption entry given through entries 7 and 45 of notification 12. So again, that will depend on the turnover of the preceding financial year, whether you are eligible for the exemption or not. So that takes care of the first basket of the discussions which we were planning to have. We now go to the second basket, wherein we talk about certain obligations which are applicable to most of the organizations. The first basket which we talked about was primarily much more wider in its coverage. And when we look at the procedures of annual compliances, the first provision which comes to our mind is Section 20. As we are aware, Section 20 deals with input service distribution. And if you are registered as an ISD and you are distributing input credit, the Section 20 says that if there's any common credit, that common credit will be distributed in the ratio of the previous financial year's turnover of the recipient units. Now, because the change of the financial year happens, this distribution ratio will keep on changing, because the actual turnover at each of the recipients' locations might change based on the financial year. Therefore, there is a need to recalculate the distribution ratio of the common credit as far as the input service distribution is concerned. The second obligation, of course, clearly, this is something which is very important, especially if you are an exporter or a supplier to an SEZ. We are aware Section 16 gives you an option of zero rating, which means that you can export without payment of tax, or you can export with payment of tax and rebate. Now, if you are exporting without payment of tax, the section requires that you should have a letter of undertaking. And this letter of undertaking is an annual process. So at the end of each financial year, you have to renew your letter of undertaking. It's an online hassle-free process. And I would believe that most of the people would have already done it. If it is not done, one should just immediately go and do it. Even if you don't have exports, there's no harm in taking a letter of undertaking, because there's no cost. It's just a compliance issue. And it enables exports without payment at any point of time thereafter. So there may not be any surprises if this renewal has been undertaken. Next aspect is relating to exempted supplies. Most of the organizations would have some or the other exempted supply. If nothing else, they will be trading in securities, which is also deemed to be an exempted supply. And because of that, the provisions of Section 16 and Rule 42-43 get triggered. Because of those provisions, if there is any common expenditure, the common expenditure can be claimed as a credit only on the basis of a proportion, which we say is an expense of ratio, which deals with the proportion of exempted supplies to total supplies. And this expense of ratio is generally calculated month on month on a provisional basis. And at the end of the year, one has to do a final expense of ratio and accordingly either pay back the difference or claim a recredit of the difference. Now, naturally, all of that has to be done at the end of the financial year. There's an outer timeline of September for doing it. Of course, if there is a payable amount, then that interest starts trickling in from the 1st of April itself. So earlier, the better it is. Real estate if you are having a new project which is liable for 5% tax without input tax credit, in that case there is a 80/20 notification which requires you to procure at least 80% of your procurements from registered dealers. And if there is a shortfall of procurement, then you are required to pay tax under RCM. That tax also has to be paid under notification 7, and that again comes in at the end of each financial year. You have to pay it, and at the end of the project you have to recalculate that entire calculations. Naturally, there is also, as the year changes, there might be a need to change the document series. Generally, the document series are continually numbered. In some companies, they are changed at the end of each financial year. So if you're doing that, you will have to reset the document series in case of tax invoices, debit notes, credit notes, bills of supplies, and delivery challans, and many other documents which might be relevant for your business purposes. Now, GST, friends, as we are aware, has certain options in terms of choice of taxes to be paid, either the rate of tax or the person paying the tax. And all those options typically work on the basis of a financial year concept. So when you look at the first situation, as a banking and a financial company, if you are a banking and a financial institution, you have an option of either expensing of input tax credit based on the actual exempted turnover ratio, or choose a lump sum 50% reversal. Now, this change of option can be done once in a financial year at the start of the financial year. So because of the change of the financial year, if in certain organizations one finds that 50% is too constraining and one wants to move at the actual ratio, they could do so right away. Second situation is Rule 32, where if you are trading in foreign currency, you are engaged in the business of foreign exchange conversion, then there is a situation that you can go by the actual profit and calculate the normal GST rate at 18% on the actual profit, or depending on the slabs of the foreign currency dealt with, you can choose a percentage based on the gross value of the currency exchanged. So that choice also can be made at the start of the financial year. So again, that is, if required, one may choose one of them. As far as the forward charge mechanism is concerned, we are aware that GTA, generally reverse charge mechanism, is applicable. But if the transporter wishes to collect and pay the tax himself, he can choose a forward charge option. Again, both the options of 5% without ITC and 18%, 12% with ITC, both of them are available to the GTA. But if he wants to go into forward charge, he has to file a document called Annexure 5, and which again has to be filed at the start of the financial year. In fact, it has to be filed before the financial year, and the date is already over for that. But yes, this is one more aspect which one needs to bear in mind, that if a GTA is choosing a forward charge, then this document has to be filed. Similarly, an author who is transferring his copyright in a literary work to a producer has an option of paying tax under forward charge, or the producer will have to pay under reverse charge. Either of the two possibilities are there. And serial 9A of notification 13 says that if the author chooses to pay tax under forward charge, he will have to file an annexure 1 as mentioned therein. And thereafter, he can collect the tax from the producer and pay it. Otherwise, it's going to be the producer who will be paying the tax under the reverse charge mechanism. This is a timeline which we've kept on talking again and again, but because it's an end of the financial year and the meter starts ticking from now, I think it's important to keep on reinforcing this timeline. That is relating to the claim of input tax credit, amendments to GSTR1 data, which is B2B, B2A, B amendments, debit notes, credit notes related transactions, all those provisions relating to financial year 23-24, one has to make sure that all these are reported in a return to be filed before 30th November. So therefore, the GSTR 3B to be filed for the month of September, which is due on 20th October, will have to, the GSTR 3B for the month of October, which is due on the 20th November, will have to make sure that all these amendments and all this matching and other things are taking place before that date. And since this has been in implementation since a few years, most of us are aware of it, but it's important to just rebrush on that facet. That takes me to the last facet relating to the accounting aspect. And then whenever we talk about closure of the financial year and accounting, I think the first thing which comes into mind is provisions. Provisions for incomes for the particular financial year, but billed in the next financial year. Provision for expenses, which will where the invoices will be received in the next financial year, but the pertaining to the current financial year. So both those aspects become very relevant, and accounting principles require you to create these types of provisions. Naturally, once these provisions are created, At the end of the financial year, there will be a reconciliation item, which because your income will be stated at a higher value, GST law would be dealing with the time of supply and the raising of the invoice, and therefore typically this will be a reconciliation item. But please note that the GST law, while it primarily works on the invoice and the receipt, there is also a concept called time of supply, which says that if there a milestone has been achieved as per the contractual obligation, or if the service has been completed, there is an obligation to raise an invoice. So therefore, while this is generally a revenue neutral reconciliation items, at times we see the department authorities questioning this adjustment or reconciliation on the ground that perhaps the service has been completed. And therefore, there might be a need for a detailed review of the contracts to examine whether there is actually a situation of a oversight of invoicing and whether the time of supply has actually been exhausted. And that aspect becomes very relevant when you're looking at this aspect. The next situation which comes in is the provision for credit notes, which is a negative provision in the income accounts. Now, when you are having a negative provision, it will be important to look at whether that negative provision, which will be later on supplemented by a credit note, whether those credit notes will be allowable credit notes, because GST has a very specific provision about allowability of credit notes, both in terms of the content and the circumstance for the issuance of the credit note, as well as the timeline for the issuance of the credit note. So from both those perspectives, one will have to be slightly careful about negative provisions being created in the books of accounts. And of course, with Ind AS getting implemented, many a times we find that there are Ind AS adjustments in the income schedule. And many of them may not merely be a timing difference. There might be a conceptual difference. And that conceptual difference might reflect the existence of a non-monetary consideration. For example, if there's a huge deposit received from a tenant, the Ind AS adjustment might require you to recognize a notional rent and a notional interest, notional rent income and a notional interest expenditure. And both of them might ultimately nullify at the end of the year. However, the existence of this type of an Ind AS adjustment might trigger a query from the department to say that this is nothing but a non-monetary consideration and therefore should be liable for GST, because rent would be a subject matter of GST. So someone will have to be a bit careful about Ind AS adjustments. While many of them one might be able to brush aside as just a timing difference, not all of them may fit within that basket. Same way, when you are looking at provision for expenses in books, it may indicate service is received but invoice is not received. Again, if the vendor is raising an invoice in the old financial year, you might need to stick with the timelines which are mentioned under the law, and therefore one will have to review that entire provision from that perspective. If the expense is such that it triggers an RCM liability, please bear in mind that the time of supply for RCM is not just payment basis, it is also 30 days from the date of the invoice, and in case of import of services, from 60 days from the date of the invoice. So if that deadlines are triggered, then one will have to trigger the RCM liability also, even though you have not really accounted for the invoice and not really passed an entry, but only passed a provision in the books. In case of import of services, please note that for associated enterprises, RCM gets triggered only on the basis of the passing of the entry in the books of accounts also. So as on 31st March, you might pass a provision entry. The RCM liability for import of services would get triggered. In many cases, what might happen is the quantification of the provision itself might have happened a bit later, and therefore there might be an entry which is passed with an effective date of 31st March, but practically calculated sometime in April or May. Now, this will also lead to a contingent interest exposure because of the timing difference which comes in and the time of supply provisions. At the end of the year in accounting, you might also find various write-offs and write-backs, and especially when there are write-offs of in goods, there might be an implication of an ITC reversal under section 17. So that also might need to be taken into account. If there is a foreign debt which is written off or a discount given to a foreign customer, one might need to examine the impact on export refunds, because one of the conditions of an export refund is that the foreign currency has to be realized within the timelines mentioned. Now, in case of a write-off or a discount, you will not receive the foreign currency at all, and therefore it is likely to have some impact at ground level on the export refunds claimed for these types of exports. When you are writing back sundry creditors as other income, again, there are 2-3 concerns which the department typically raises. One concern is relating to the 180-day reversal, because if you have claimed input tax credit on the creditor and then you've not paid him, then naturally after 180 days, there is a requirement of an ITC reversal under the provisions of Section 16 itself. If this doesn't, if anyways this is not the situation, at times the department also tries to link this to be some element of a service, either in the nature of an agree to tolerate an act or do an act, or in terms of some marketing incentives or cashbacks or something given. So from that perspective, one will have to be a little bit careful about this facet about the right backs on account of sundry creditors. Many a times, many organizations, because of the matching provisions, retain the tax amount, and they agree to reimburse the tax only after the credit is visible in the GSTR 2A. Now, in these types of situations, if the company has retained the tax and later on there is a write back of that tax, then naturally it will be very clear that you cannot claim the input tax credit as well as take it back into your P&L account, retain the tax and take it back to your P&L account. There could be an impact of unjust enrichment, and it can have an impact on your pending litigations on that front. Finally, when we look at reconciliations at the end of the financial year, I think the broad process flow, we are all clear that the invoice generated through the IRN and the associated e-way bill flows into your GSTR 1, which in turn flows into your GSTR 3B, and the taxes are being paid, which ultimately consolidates itself into a GSTR 9, which gets reconciled with the financials. Now, in each of these cases, there will be a reconciliation both vis-a-vis the values as well as vis-a-vis the taxes. And this process, I think, needs to be streamlined. And many places, what we see is there are some aberrations in this entire chain. And wherever there's an aberration, you will find that there is some element or a need for some reconciliation between those two sets of data. Coming back to the books, we also find many cases that there is a need for a GL offset or a reconciliation. And again, that will have to be registration wise. So for each GSTN that an entity operates, the output tax reconciliation, which might include not only the broad output tax collected, but also the TDS and TCS if applicable. Input tax credit reconciliation and along with the GSTR 3B filed reconciliation. There is a deferred ITC for various reasons like unmatched, unpaid, etc. Or consciously we have deferred the claim of input tax credit. So all of that reconciliation, the reconciliation of RCM liability and refunds are received and receivable. So all these reconciliations will be very important. What will also be important is that there is an offset entry in the books of accounts offsetting the input tax credit with the output tax. Otherwise, there can be at some future point of time a huge balance in both these accounts. Netting out, it might just net out to zero. But if there are separate accounts, it's important that the debit balance in one account be taken to the credit balance of the other account, and accordingly the offset entries be passed in the books of accounts. Also, when all these reconciliations are done, it's also time for appropriate vendor follow-up in case of vendors who have collected the taxes from you but not reflected it into your GSTR 2B. Certain further things which we need to keep in mind. I think the major aspect which from here which I would just touch upon is about the cross charge versus ISD. And as we are aware, the current Finance Act has proposed an amendment in the law whereby it is now said that ISD will become mandatory. We are awaiting a clarification in this regard and also the effective date of the notification. And accordingly, many of the organizations might need to relook at their current principles of cross charge and ISD, and then streamline the process to implement both cross charge as well as ISD as the case may be. Registrations, I think at the end of the financial year is a good time to review the content of the registration, maybe the number of addresses, the key products being and services being dealt in, the director's details, bank account details. We are seeing that of late, if there are any lapses in change of information being communicated in the registration, penalties are being imposed by the officers. So one has to be slightly careful about this. If you're claiming refunds, and Aadhaar authentication is a must. So if that has not been done, then that also should be done. And keep in mind that if there are any open-ended accounting entries or adjustments, especially relating to your debtors or creditors, and if there are some payables which you are showing in the books of accounts, there might be a risk of a garnishee proceeding, because at times, if that person has not paid to the government, then the department is entitled to collect the tax from you by way of issuing you a notice in form of a garnishee proceeding. So therefore, it's important that the house is set in order, and if there are any need for internal adjustments of debtors against creditors or anything, that also should be taken up at the end of the financial year so that the accounts reflect the correct financial position of the organization. In the financial reporting aspect, we at times see the statutory auditors insisting on reporting of contingent liability provision or creation of provisions, especially in case of notices being issued at times, DRC 1A or DRC 1 notices being issued. One will have to be slightly careful about how this has been worded so that it does not somewhere boomerang in terms of the legal position of that notice. So while there might be a little bit of a balancing act which might be required as far as this is concerned. Same way, when there's a qualification relating to GST in the financial reports, it may be important that that qualification, the proposed qualification, is discussed and brainstormed to make sure that any positions taken by the organization are not conflicting with the type of the qualification which is made in the financial reporting, or any disclosure which is made in the financial reporting. So with that, I think these were some of the issues which we felt were relevant as a change of the financial year takes place. I hope you enjoyed this session. Next week, we will have one more session, and please keep looking forward for these types of sessions, and share the feedback with us so that we can take up topics of common interest to everyone. Thank you.